Hello, hello, hello. Can everybody hear me?
Good evening, Mr. Gibson. Yes, we can hear you.
Good afternoon, everybody. Welcome back. Time flies when you're having fun. We were just chatting a few minutes ago, and here we are again. I hope everybody had a great weekend and no major blah, blah, blah. All right.
Yeah, good evening,
Good evening.
Mr. Samuel. Just to start out, I'm actually here, but I'm in a meeting as well. So I'm listening. I'm just muted, but I'm in a meeting as well.
Oh, okie dokie.
Yes, sir. Okay.
Not a problem. Glad
Yes,
to have
sir.
you here nevertheless.
All right.
Okay. Melanie, are you here? I don't see Mel yet.
Yeah, she's here. She said good evening a while ago. I don't know.
Okay, she'll kick in. Okay, great. How's Corey doing? Any word on him? Is he getting better?
And he's out of the hospital, so that's a good sign.
That is a good sign. That is a good sign.
Rest of
Sounds good. Hopefully, with another week of rest, he'll be able to join us. If not on Thursday, next week, Monday, hopefully.
the-
Please give him my regards. Kevin Farrington.
I'm here. Good evening, everyone.
Evening. Kevin Joel.
Yes, I'm here. Good day, everyone.
Doing good day. And of course, Damien is here. He's spoken up already. Badiro is multitasking, but he's here. Tremaine. Is Tremaine here with us yet?
I'm here,
Okay, excellent, Tremaine. How are you today?
alive by grace.
I love that. That's fantastic. That makes two of us for sure. All right. So we're making something of a 350-degree turn today because we're moving from the discussion on corporate governance per se to another kind of governance, but this time it's more from a financial perspective, more specifically an accounting perspective and financial accounting perspective. A lot of governance problems have come out of bad accounting practices, too much of which were deliberate, too much of which were driven by senior management and board members in major and not so major organizations. So the purpose of the next couple of sessions is really just to get you acquainted with some of the language of this financial accounting thing. So when you're sitting in your board meetings or elsewhere and you hear certain things, they wouldn't be completely alien to you. You will not be bookkeepers and accountants when you're done, but hopefully some things will make a little bit more sense to you than they did before, especially when it comes to financial statement information and what they mean. Okay.
Good evening, Ms. Wilkinson. I'm here.
Hi, Melanie. How are you?
I'm good. How are you doing?
Fine. Fantastic.
That's great.
Little note here. Great. Melanie. Okay. Does everybody have the notes on financial literacy for board members? The first set of notes with my name and phone contact and all that on it? The one that talks about key topics. I think that's the second slide. Does everybody have that?
Yeah, it's in the original documents that Gail sent. It's there.
Yes. So you should have access to that. So you can follow me in the process. Okay. What I will do, just maybe for the convenience of some persons, I'll see if I can share the document. So if you want to, you're getting caught up or stuck with what you have, you can just kind of follow through with my. Can everybody see my slide now?
Yes.
Okay.
Yes, I can see you.
By the way. All right. Before we get started then, any question issues that came up, stories about compliance and governance. Does anybody want to raise any questions, make any statements, tell us any stories about something that might be helpful to the group as far as governance as we've seen it in the last couple of weeks is concerned? Okay, I'm sure whatever they are, you'll deal with them at the appropriate time, and you will raise the questions at the appropriate time as you normally do. All right, same thing with the financial literacy side. Any questions you have along the way as we go that you want to raise, like what does stuff mean? What is that all about? Can you explain that again? Please feel free to do that. Same rules apply. Okay? We're just switching over from the pro side of things, conceptual side of things, to the financial statement side of things. Next question, has anybody in this class ever done an accounting class of any kind? At any time?
I did an intro.
Okay, so everything I say will not be foreign to you then.
It might be.
It might be by now.
One of the attorneys here, myself and Dario, Kevin, we did a law office management course at and we was doing a legal education certificate. It was a whole year long course.
That was a whole year long. Did it
Yeah,
involve
but
any
people-
accounting and finance?
Yes, it's a lot of people and balancing of spreadsheets. It was basically for office management of a firm. That was
Okay.
my story that we did. So we have some recognition. from those.
Yeah, something might kick in. That's okay. If you've done it at all, I'm sure as we go along, some things will kick in. And of course, there might be new things added to what you've done. So either way, hopefully at the end of the day, you'll be a little more enlightened. And that's really the real objective. Because remember, at the board level, you don't really need to get into the nitty gritty. That's why you have bookkeepers in the accounts department and financial controllers and CEOs, CFOs who head departments and other trained people down the line. So really at the board level, I'll be talking to you about a few technical things here and there, but you don't really need to be tied up in them because that's not what you're being paid to do. You have lots of people down in your accounting and finance department who are being paid to do the nitty gritty and the details. You just need to understand what the end results mean so that you can make the proper decisions for your union. And now that you have all this governance stuff behind you, you will be able to take some of that now to remind you that if somebody is messing around with your financial statements or they cannot give you a clear response to any questions you ask about them, especially after these next few sessions, then you should at minimum be concerned. And if necessary, you don't have to lose any sleep calling your auditors. If your financial controllers cannot give you answers you want for some reason, then call in your auditors and ask them to explain what's going on. Because at the end of the day, you guys at the board level just want to know what's going on, make sure that there's no hanky-panky and everything is going according to plan. Okay? What is the plan? Good governance. That's the plan. Right? Interestingly enough, I had, by way of an example, before we actually get into this stuff, my oldest son, who's an IT systems guy upstate in New York, in Albany, he called me this morning and said, actually before he changed his major to IT, he was an accounting major for about a year, and then he decided to change to IT. Anyway, he called me and said, Daddy, I have something interesting to tell you. I'm like, okay. He said, it's kind of an accounting matter. I'm like, really? You remember something from accounting? Or that full year that I spent for you to do accounting and then you switch majors? Or you actually remember that? So yeah, what happened is one of his managers came to him and said, Sam, we have a laptop in there that was given to us by Microsoft as a gift to promote their products, and I'd like for you to get it ready because one of our senior managers would like to purchase it. And then he went away. Now, before we even get started, I would like to ask you guys, just a little mini case study. What's wrong with that scenario, if anything? Because remember, you're directors now. And when you hear certain things like that, something is supposed to click. What's wrong with that scenario? Is anything wrong with it? Hi.
Yeah, could you just repeat the last part of that scenario? Like, I just that.
Yeah, here, let me tell you again. One of his managers came to him and said, Sam, I want you to prepare one of the laptops that we received from Microsoft gratis as a promotional item because one of the senior managers would like to purchase it. And then he left. When it's ready, call me or bring it. What's wrong with that? That scenario. If you don't say anything wrong, you can say I don't say anything wrong.
No, I'm trying to get the gist. So you said one of the senior managers told him to purchase the laptop and then bring it to him?
A regular manager said, prepare the laptop. In other words, upload all the information on it because a senior manager wants to buy it. When you're done preparing it for use, bring it to me so I can take it to the senior manager.
You saying to clean it? I'm trying to get you clean the laptop or
No, not clean it.
download the
No, not clean it. Load up the software that is necessary for it to work. Put on the Microsoft 10 software and all the other PowerPoint, Word, all that stuff for it to work. That's what he means by prepare.
and then yeah, exactly that. I think personal. So is this company business or this is personal laptop that he is getting uploaded with this software?
It's the company's laptop that was given to the company by Microsoft as a promotional item. So it's the company's laptop.
Yeah, but should he have access to those softwares and stuff? That's what I'm trying to get.
Well, yeah, the software is fine. Little Sam is responsible for the software. He's responsible for the equipment that's locked up in storage until they need it. The computers and the software and all that stuff. So that's not a problem. Where do you think the real problem is? And this is one of the reasons why we talk about control measures, controls.
Should Sam be doing that? Because Sam could put anything on that computer, all kind of confidential information.
True. Let's assume that because he's the new kid on the block and he is going to do it the proper way, that there's no problem with the information that's going to be loaded. Let's assume that that is not going to be a problem. Do you
Okay,
see
so
any other problems?
Is the computer supposed to be for his personal use if it's for the company?
Well, now we're getting warm. A little warm. First of all, a manager came to him and said, to little Sam and said, get the computer ready because one of the senior managers want to buy it. Okay, let's assume that the company has a policy. That's the first thing. That's the first control. What is the company policy on staff members purchasing company equipment? Does everybody get that?
Okay, yes, you're
That's
right.
the first problem. Okay. The second problem is how the hell he can come by word of mouth and say the guy wants to buy it. But if he wants to buy it, then he should go to the accounts department, make arrangements to purchase it, and then bring little Sam what?
A receipt of that.
Or
from the
receipt
department,
or a
from the
document
department.
saying that it was purchased and cleared for release. Correct?
Yes, indeed.
Okay. Also, the document needs to have the details concerning the computer that is leaving the stock, in particular, the serial number, correct?
Indeed.
Now, if none of those controls are in place, and little Sam goes ahead and prepare it and give it to the guy, and somebody comes back 3 months later and says, where's that promotional laptop? What will little Sam say? Well, Tom Jones asked me to prepare it for Elvis Presley, and that's what I did. Then they say, well, where's the evidence of that? They said, well, I don't have any. So who's going to take the fall?
Definitely the senior manager, they didn't put it
No,
up.
no, no. The manager who came to him and said, prepare, he's gonna lie. So I don't recall telling little Sam that at all.
Exactly. That's what I'm saying. So the little Sam will let him take it.
Little Sam has to take the
Of
responsibility.
course, little Sam will take the fall. As with anybody who finds himself in that situation and doesn't take the proper control steps to cover your butt. That's really the point in all this. So when we talk about accounting controls, that's one of the fundamental areas. That doesn't even get into the deep side of it yet. That's just one of the fundamental areas, but it's very critical. So when he tells me this, I said, listen to me, son. I know you are going to do it in good faith. But in the real world, there's no such thing as good faith for the most part. I suggest you send Tom Jones an email letting him know that you're confirming your conversation with him to prepare the flicking laptop serial number 23QFG, and that he has given you instructions once it's prepared to present it to him and have him confirm the email. If he doesn't like it, too bad. Because at the end of the day, if something goes wrong, Samuel Jr. will take the fall and nobody will come to protect him. Especially the one Negro in an all-white firm. Sorry, just thought I'd throw that in as backup. But they tell me that stuff don't exist no more, but I don't know. I think it still does, unfortunately. So there are two reasons why he take the fall. One, because he has no proof and nobody will come forth and support it most of the time. And secondly, I don't want to go there, that's madness, but it's still true all too often, okay, in those places. So that is a case study on control measures. All right, so if you're a board member and you have a concern or question, and for some reason, the relevant people keep trying to avoid your question, is that a red flag for a board member?
Yes, it is.
Of course. Of course. If you're looking at a financial statement and you see an expense item for $100,000 under miscellaneous, should that concern you?
Yes, I would think that they come, they should see something, say something. You can't just let it die, because everybody will be held in account.
Well, everybody would tend to let it die if you let it die. But let's say you, the board member, who wouldn't let it die. You see 100,000 in miscellaneous expense, and you say, why is this in miscellaneous expense, all this money? Miscellaneous expense is only supposed to be for minor expenditure. And your financial controller says, oh, don't worry about it. It's a couple of items we threw in there. Try to brush you off. Should you be brushed off?
No, you shouldn't. You should be. You have the question. Any missteps or whatnot. So I would
Well,
say you deserve to know.
Well, I'm giving you a cue right now. If you're looking at miscellaneous expense in your income statement, we're going to talk about these statements later. But if you're looking at miscellaneous expense that should only have small expenditure, 5,000 or 10,000 or something, and you see a big number, accountants and other senior management people like to hide stuff in miscellaneous expense. Did you know that?
Heard.
Perhaps you didn't know that. Well, if you didn't, then you're already ahead of the game as a result of today's class. So now, whenever you look at an income statement in the future at the board level, the first place you might go is miscellaneous as a result of this conversation, I hope.
Absolutely.
Absolutely. Melanie, thank you very much. A lot of things are hidden in miscellaneous. A lot of expenses for people's personal agenda that oftentimes are not even company or union related could be hidden in miscellaneous. So when you board members sit down to look at an income statement and you go to miscellaneous and the number looks too high, you need to ask questions like, we need a breakdown of what constitutes this $37,000 in miscellaneous. Don't be surprised if you don't get a straight answer right away.
That's a broad, miscellaneous is a broad category.
Too broad. Okay, board members, and a lot of non-improper governance goes on, not only in financial statements in general, but in accounts like miscellaneous in particular. That's not the only account, but that is one of the key accounts where it could occur. And it's one of those accounts, if you're not familiar with the conversation I'm having with you today, you can just overlook it, especially if you're not quote unquote into that stuff. Which is probably why at some point in the future, your INED that you might choose not to call an INED, then might just be Tingham that you bring onto the board with a little background to look at those kinds of things that you may not be into or even understand no matter how you try. And therein lies the benefit of those kinds of things, if only for those kinds of things. All right. Word to the wise. That's the whole idea about this part of the course, just to kind of introduce you to some interesting stuff. Okay? Miscellaneous expense. It's my foot. All right. So what are we going to be talking about? A lot of little things, right? Key topics. Again, all these things are not going to be discussed with you in detail. That's not the idea here. These things are principles that takes years and years of study to actually get through all of them. So that's not the objective here. The objective is to introduce you to them, to give you some basic concepts about what they are and how they work, so that when you go to work as directors and you see a financial statement or you are in a financial discussion, financial statement discussion or such, you wouldn't be totally out of the discussion because you just have no idea. Okay. Hopefully some of this language, some of this conversation, some of these topics will prompt you to be a little curious as directors when it comes to discussing the union's financial affairs, because a lot of poor governance tends to take place in financials, on the financial side of things. Okay? Because we don't really know, a lot of things can be hidden, misdirected, and so on. Sometimes even the auditors don't pick them up. And in some organizations, the auditors pick them up, they just don't disclose them because they are now what? In cahoots with management for one reason or another, none the least of which is money. Because money will create all kinds of governance problems all the time, financial statements or otherwise. All those things we studied so far, if you don't be careful, money will cause you to like ignore those things and go the other way, look the other way, do the other thing. So we're studying the academic side of it, but we know in reality, when people come with dollar bills and checks and trips to Waikiki or whatever folks use to try and bribe you to do stuff, those things are real as well. So you would have to make those decisions on an individual basis. Our goal here is just to give you the information, and then you can decide, God forbid, which way you'll go. All right, so what are some of the key topics we'll be looking at? Accounting principles, a few of them, just to warm you up. Then we're looking at an equation called the accounting equation, just to connect you to the balance sheet and how it works. Then there's a concept called double entry bookkeeping, so that you understand the very fundamental basis for the bookkeeping process in accounting, such that if your organization is not adhering to double entry bookkeeping, then they are doing something wrong. So you don't need to be an accountant to know, but if you hear any conversation that the bookkeeping is not based on the double entry system, you can jump up and say, oh, I remember that. And then you can have a discussion about it. Who are the users of financial statements? So who's using the union's financial statements? It's another important topic. Of course, the income statement, which I believe you all would have seen at some point. The balance sheet, of course, another very important statement. And the cash flow statement, a third very important statement. We're going to be talking about all of these things and how they can impact the day-to-day operation from a financial perspective of the union. And every now and then I'll throw in a little nugget just so that you can see how financial statements can be actually manipulated in order to reflect incorrect or incomplete information for one reason or another. For those of you who've heard about Enron or checked it out, you would have discovered that Enron just went into the general ledger account where the sales account was and told the CFO to increase the sales by a couple of $1 million so that their net profit could be bigger and their bonuses can be bigger. That's what they did. Those sales never occurred. Just go in and credit sales. Sales had never even happened. Then they took some expenses and what we call capitalize them. In other words, they took expenses in millions of dollars and showed them as assets on the balance sheet. So the balance sheet could look stronger and the income statement can look stronger and they can look stronger and therefore their bonuses can be bigger. Unfortunately, when push came to shove, it was discovered that the company had borrowed more than it should have borrowed. The information on borrowing was not on the balance sheet. They had it hidden off balance sheet somewhere, and eventually the whole thing collapsed. And now Enron is no more. Okay? All because it started with an accounting fraud. See? An accounting fraud. Somebody at the board level got the CFO to go into the general ledger. And you'll find out what all these things are if you're not familiar with them. And change the numbers. But never occurred. That's how serious these guys are when it comes to greed, malfeasance, and whatever else the hell they do in the name of money. What is interesting from a governance perspective is that a lot of these guys who are doing this stuff are not poor. They're not like us, like poor, regular, hardworking folk. Most of these guys are guys who are already making millions of dollars in bonuses and salaries as CEOs, CFOs, and all kinds of other O's already. But it's like it's never enough for some strange reason. And so they break all the governance rules just to get more to pile upon the more that they already have.
The wives.
Yes. It's one of those things that the Bible refers to as greed. And even though we downplay the concept of greed, the problem is greed is almost as strong a desire, or sometimes for some people, even stronger desire than sexual desire. And we know that sexual desire is something you have to beat down constantly to control. Okay? And so greed is way up there with sexual desire. And for some of us, it exceeds sexual desire. Greed. It is sick. You wonder, like, John, don't you have a couple of million already? Yeah, but I need more. What do you need it for? Well, I just need it. Like a junkie. I need it. For what reason? I don't know. I just need it. And so you have all these crazy governance things going on. Believe it or not, it's a strange phenomenon. Okay? We'll talk a little bit about budgeting. Have you guys ever been involved in budgeting of any kind at board level? Yes, no?
Uh, yes, I want to say yes.
Yes,
Yeah.
we have looked at a few budgeting, but not as in detail as I guess the treasurer and the manager may
Indeed,
do.
indeed. So when the manager and the treasurer is done with the budget, they just give it to you guys to approve then?
Yes.
We
Yeah,
kind of looked at it, but it's also read over at the AGM, also for the members to approve it as well. Or question if they have any questions, they could raise it at the AGM.
indeed, they can raise it at the AGM. When budgets are being done, are the persons who are preparing the budgets required to give explanations for the numbers in the budget?
They should, but I don't think that happens at our level.
I'm glad you actually can confirm it, because a lot of times it doesn't happen, but folks don't really say. But you're right. It's not unique to your organization at that level. It happens in a lot of organizations where by the time the budget gets to the board, it's just, for many boards, a rubber stamp transaction unless something specific comes up. Okay? And so what happens is board members tend to rely heavily on the manager or financial controller or treasurer, whoever it is, who puts these numbers together, and sometimes don't even ask them to explain the numbers they have in the budget, which of course is an interesting phenomenon, because we're going to be looking at one or two interesting things in the budget that should be up for discussion every year in the budget exercise. Not just only throwing some numbers together and say, okay, this is for salaries next year, this is for BEC, this is for BPL, this is for entertainment, this is for whatever the case might be. But there are one or two key questions that need to come up as part of the budget exercise as well, outside of just coming up with the expenditure numbers for the next year. In case you didn't know, just like miscellaneous expense, a lot of things can be hidden in budgets too. Just like the budget that they're currently debating in the US, this $3 to $5 trillion budget that they say that they want to have money to plant trees and look after the poor and take care of Black people and build this and that. That's what they say in the budget. But in practice, the money does not necessarily go in those places. If it goes, so only a small amount, and the rest goes wherever they really want it to go. They just use the budget to camouflage their intention. Happens all the time. And anybody who's bold enough to speak against it will come under fire, depending on who you're speaking against. But that's another matter. That's a compliance governance matter again. See, that's why we go into all that governance discussion about what's right, what's wrong, and what's ethical, because now all of a sudden it's rolled over into miscellaneous expense, other aspects of the financial statements, and the budget. And sometimes the person who's raising budget questions should probably be somebody who's not connected to the organization, like an INED, or somebody who's invited in on certain kinds of meetings to be a part of those kinds of things, to review, to look at it. And when I say that, I mean somebody who's independent of your own external auditors. That's the other thing. But sometimes companies' external auditors are too close to the management as well. And oftentimes they cannot and do not give an independent perspective, unfortunately, even though it's their job to do it every single time. My. I know, all of a sudden, this little simple thing becomes like a little nightmare. Like, what the flick?
It's the very stuff, Mr. Robinson.
It is.
Heavy stuff.
It is. And believe you me, what's not only is it heavy, you're right. It's spooky, and it's the tip of the iceberg of
Boy,
yeah.
I wonder if this corporate governance or should be a criteria for person who aspire to higher office all around our country. And they even because a lot of people, for instance, the electoral process almost popularity,
Yes,
there's myself and whatnot. But then when you get there, you're now part of the executive
yes,
branch of the country. The good leader should, well, especially for newbies. Now, some who would have learned by practice and have been around it for years, they understand it to a sense.
yes,
For the newbies, it should almost be automatic that they go to a seminar, workshop, or whatever, I guess to familiarize them with what is expected of them. Because a lot of people speak and use this word moral. You understand, man? It's moral principles and ideology of what morality is all about.
yeah,
But when it comes to I think the corporate government or on large scale in organization in the country and government or whatever, it should be really said, spoken or said to them. Someone should speak to them about it.
correct.
It don't have to be, a degree process like how we doing this. So at least you can get a proper understanding of what is expected of you in the government of the biggest organization, which is the country.
Absolutely,
Everything is an umbrella. Everything is under that umbrella.
absolutely. Um, couldn't put it better myself. And unfortunately, it's the same kind of dilemma that we have across countries everywhere in the world. The problem is every government around the world, depending on their ideology and their agenda, all too often they run what we call run amok of what the proper governance requirements are supposed to be, such that even after if you go in with good governance intentions, by the time you get in the middle of that stuff, you realize you're in the middle of a bloody hailstorm because there are so many non-corporate governance activities going on. There's so many unethical things going on that now you're stuck with only two choices: to join the bandwagon or get the hell out. Because you have a third option, that is to try and change it. The only problem is countries and organizations all too often don't give you the opportunity to change it. And if you remain too persistent, they do everything to you, from ridicule you up to murdering you, depending on how close you're getting to what and which country you are in. So therein lies the problem with this governance thing, because what it requires of us sometimes is all too often incongruent with the non-governance and unethical behavior of countries, politicians, organizations, and boards of all kinds everywhere. And so a lot of people go in with great intentions, and then they realize that what the hell, I can't seem to change anything. Every time I try to change something for the better, everybody gets mad at me. So now I'm only left with join the bandwagon or jump ship, get out.
Yeah,
All right.
correct. I wish, I mean, this it is an unspoken. This is the one thing about government.
It is unspoken.
Unspoken thing, but we know from tradition, from a child, and especially in quote unquote Christian nation built on Christian values.
Yes.
Must be in our contribution.
Yes.
Learn it from a child is taught in school. You go to Sunday
Yes.
school.
Yes. We know.
the morality part is there, but then as we get older,
Yes,
into these various organizations, whether it's a sporting organization, a sporting club,
whatever it is.
or whatever it is,
Yes,
whole thing about with the proper way the governance comes in. But it's like we all just turn a blind, not all, but majority of people turn a blind eye to it.
yeah, that quiet, blind eye, that conciliatory, quiet, nobody move, nobody gets hurt kind of thing that we all just seem to learn by the time we get to these places, even in church, even in church, God's house, amen, hallelujah, Jesus, and all that stuff. Man, where you're supposed to be able to raise any question. You can't ask the bishop nothing about what's going on with the money. As soon as you start asking the bishop and the deacon about the money, all of a sudden everybody stops talking to you. They start looking at you funny. And if your luck is really bad, they'll drive you out of the church, God's church. Imagine that. So if you have these issues going on even in church, imagine anywhere else. And therein lies the challenge all the time. And so we're left, we study this stuff, we learn it, we find out what is required. That's what we're talking about. This is how it should be. And then all of a sudden we're thrown into an environment where it's not that. And now we're stuck with three things. Try to change it, join in it, or be booted out of it, never to be invited back. And then word gets out. That Damien boy, he likes to ask certain questions. You'd be surprised. So when you go somewhere else to contribute, it's, oh, that's him. Yeah, and Tom told me about him. Okay, yeah, Kevin told me about him. I don't think it's a good idea. But why? Well, don't worry about why. Just don't do it. So this is all crazy, unspoken. How the hell does it happen by the time you grow up thing? Just like you said, when you're small and growing up, you learn right from wrong, what's the right thing, what's the wrong thing. But by the time you grow up and get into these systems, somehow they quietly, indirectly, and subtly teach most of us how to fall in line or else. Yeah, kind of spooky. All right. And it all ends up being a what? Individual decision. Okay. All right. So budgeting, yep, we're going to talk a little bit about that. Stuff can be hidden in budgets too. Okay. We'll see at the end of the day if we can find out how. Then we'll talk a little bit about the audits, the purpose of the audit that you guys have, the internal audit, the external audit, and again, a little bit about ethics, but this time from a business perspective, as opposed to a compliance perspective and a regulatory perspective. Okay. So quite a few interesting topics right off the top that we'll be looking at over the next few sessions. All right, so let's go back to the beginning. What is accounting? What is accounting? Now you'll notice in your notes that accounting has several definitions, but at the end of the day, they all equal kind of the same thing. Okay, let's look at the first one. Accounting is the systematic, see? Systematic, that means it's organized. It's not helter-skelter stuff. See that crap they told my son this morning? That's non-systematic. That's helter-skelter garbage. How the hell you could give instructions to remove the company asset without any written document? It's never should happen. I don't care who said it. If the chairman says it, the CEO says it, man, you want to remove an asset from this company? Fine. We have a policy for it. You have to do the necessary requisite paperwork. The relevant people need to sign off. And then when all of that is done, then the asset can be released. Not a moment before.
I have a question.
Yes.
Is that a true story or that was the illustration?
You mean about Little Sam?
Yes.
Absolutely true.
Okay, so how did he deal with that? What did he say to them? To the
Well,
master?
well, he was preparing the computer because he's a junior guy, right?
Right.
They come with them, like senior guy come to junior guy, give him an instruction. So you're like, oh my God. Happens all the time.
So he prepared the computer.
Yes, except they were in for a surprise. But before he was able to return it in, he had already spoken to home.
The senior manager.
No. Before he turned it in, he had already spoken to home. His father, who told him
Oh,
to do what? Send an email.
okay. Because I was gonna say, those time gonna really get caught holding the bag.
Of course. But I told him to create a paper trail. See?
Right. Right.
That's what you do, which is the normal thing. The fact that they didn't want to create a paper trail in itself was unethical and poor control and unacceptable and an absolute no-no. I don't care who
Right.
we are, where we are.
Good looking out, Big Sam.
Sorry?
I said, good looking out, Big Sam.
Yeah, that's what he said to dad. I'm happy I mentioned that to you. I'm like, yeah, that's what fathers are for. I'm happy to be alive to tell you. Send that dude an email. I don't care who the hell he is.
Keep it real.
But daddy's a senior manager. I don't care if he was a super senior. You send the email, confirm the conversation that he gave you the instruction. And when you see that he read the email, then,
Yeah. Paper trail, they call it. Eh?
of course,
So the email was for the manager who came to him
of
to
course,
just to admit that he
gave the
gave him those
instruction.
instructions. Okay.
Of course. So when push comes to shove and he tried to
Just that
deny it,
email. Right.
yes.
Right. Okay.
This
Okay.
sounds some the board members sound like something quite familiar. Eh?
Yeah, quite familiar. Okay. For your information, guys, back in the day when I was a youngster, and I say, can't believe I'm this old already. Back in the day when I was a youngster, I used to be the financial controller for the Workers' Bank for a while. Remember that bank?
Yes, we did.
Yeah, Workers' Bank was run by the Hotel Union. And guess who was president at the time? He just died the other day, Thomas Bastian.
Bastian. Right.
Okay. So I was the financial controller for that Workers' Bank organization at the time, which was controlled by the union, owned by the union. And so oftentimes a lot of interesting things happened. And so even though I was a youngster, they probably thought since I was a youngster, I was a little younger than little Sam then, that they would be able to get me to agree to stuff I shouldn't agree to. And they were in for an unpleasant surprise when they came to me with stuff that didn't fit. And I said, sorry, it cannot be done that way. This is the correct accounting procedure or whatever the procedure is. Of course, whenever you come against Tingham and Tingham, then even though that's the right thing, folks get mad at you. And all kinds of strange things have the potential of happening. But it doesn't matter. When you have responsibility for stuff, there's certain steps and procedures you have to take. Or you have to make up your mind that you're going to join the bandwagon and become a part of the governance problem, which of course a majority of people seem to do. We join the bandwagon because we don't want to lose our jobs. We don't want to lose the position as director. We don't want to lose the honorarium. We don't want to lose our relationship with Tingham. We don't want to use our political, whatever it is, we don't want to lose. And they know that. Says if you don't want to lose it, do what we say. The rest of us are doing it. Who the hell do you think you are? Do it or else. And so sometimes we panic and do it. Okay. I was not always favored because of that. As an accountant, as a young accountant, a young banker, a young offshore banker, an older offshore banker, an older banker, an older accountant, all kinds of stuff, because folks always wanted you to do something, even a compliance. I was a senior compliance manager in a French Canadian bank. We had an on-site inspection. The central bank came in and found the problems and wrote down, these are the flicking problems. We need you to respond. That's the requirement. I'm responding as the compliance senior. My managing director doesn't like the response that I'm giving to the central bank, even though that's the response the central bank requires of the bank. And he says to me, you gonna send that in? I'm like, absolutely. He says, do you realize you work for me? I said, yes, but I also work for the central bank because the law of the Commonwealth of the Bahamas requires this. Monsieur Latendresse, he was a French guy. They didn't like that. He wanted me to buckle and send information that was not absolutely correct. And I was not about to put my reputation on the line. And I had little small children, my babies were little running around my feet back then. I'm like, man, I have two Wilkinsons, don't come to me no nonsense. And I don't like prison anyway. I don't even like driving by prison. Don't come to me with that. But you get all this kind of stuff because people want you to capitulate. And when you don't, they don't like it. So I caught a lot of hell for just trying to maintain the proper position. All kinds of it. Can't imagine how I even survived it. Okay, it's a very real thing. A lot of people don't feel it because they don't take that position. They take the other position. They leave or they join. But when you take the position that you're going to object and say, this is the correct procedure, man, that's a whole different ball game, depending on who you are and who you're dealing with. And really, all you're trying to do is get people to see that that's the right thing to do. No major stuff. But again, depending on what the agenda is, you can come under a lot of heat, even at the board level. Okay? All right, so what is accounting? Accounting is a very systematic and comprehensive recording of financial transactions pertaining to a business of any kind. Business meaning profit and non-profit. But you can see from the very first definition of accounting that there's a certain amount of structure in accounting. And the structure is there so that you don't have too much ambiguity or too many hands in the pot about how something should be done. Accounting has very clear procedures. You're either doing them or you're not. There are no gray areas for the most part. And the few areas that are gray are subject to rules and regulations, even in the gray areas. And there are not too many of them in accounting. So whenever something goes contrary, somebody had to deliberately do something, like in Enron, for example, deliberately go into the system and change numbers, even though the transactions never occurred. And let me say this, in accounting, which includes bookkeeping, we never record anything in accounting until after it happens. So nobody should be going to your accounting department or anywhere and saying, please record this, it's going to happen next week. Hell no. Accountants, we don't operate that way. We say, when you say that, when it happens, bring me the proof that it happened. That's how accountants operate or should operate. See that proof, that paper? Saying the little sound, the paper. I'll bring it to you next week. Just put it, fine. It'll sit undone until you bring me the proof that it happened. It's very simple. It's not complicated. Man, you're always creating problems. Not really. The profession requires that the transaction is recorded after it occurs, not before. You can't just do that when I'm the boss. I can fire you now. Then you have to fire me. But the requirements are that we record after the transaction occurs. Easier said than done, especially if you're dealing with persons who are trying to operate outside of the correct realm, whatever it is, politics, church, business, credit union, doesn't matter. All right, so that's the first part and very important part of accounting. It's systematic, it's comprehensive, it covers all transactions, and the transactions are not recorded until after they happen. Then notice the second definition part of it. Accounting is the process of summarizing, meaning putting all the information together, analyzing, working out what's correct, and reporting the transactions.
Wilkinson,
Yes.
just want to say hello and welcome back to Corey and see him signed in. So that's
Corey
it.
signed in? Stop the madness. Corey, are you there for real?
Yes, I am.
Kiss my foot. Let me change this X to a tick. Okay, 1, 2, 3. Welcome aboard, Corey. How are you feeling, young man?
About 85%, but I'm back.
I am so happy to hear that. I don't know how the hell that happened, but I'm sure you know how the hell not to make sure it doesn't happen again.
Good
Sure,
God,
Yeah.
Corey. Good God.
Welcome
Yeah.
back, Corey. Glad to have you.
Thank you, thank you.
Happy to hear your voice again.
Yeah,
Yeah.
appreciate it.
When they told me that, I'm like, do I need to go down there and make some noise? Like, get him the hell out of there. What the hell is he doing in there? But it's good to have you back. Okay, fantastic.
Welcome back, Mr. Damianos.
Yes, you survived that nonsense.
Thank you, thank you.
All right. So yeah. So the second definition is summarizing and analyzing and reporting. So you can see accounting is a very structured process. It's not like law and economics and all that stuff. I don't know. I'm sure you guys have had the opportunity to speak to Audirio and people in the legal profession. And sometimes it is often said that it's hard to get a straight answer from a lawyer. I'm afraid that is sometimes true. I'm not sure it's always true. But accounting is not like the legal profession and economics and so on. All right, accounting is very specific, and even where we make exceptions to being specific in what we do, even the conceptual side of it, the non-number side, has a foundation on which it operates to govern it. So even the non-number stuff is not helter-skelter based on how you feel, some opinion, or some off-the-wall language. Okay. All right, and that's what makes accounting significantly different from many other kinds of professions. Okay? Also, accounting, we are told, should be run specifically by bookkeepers and accountants. If people have not had training in bookkeeping and accounting, they should not be doing this work. That is never a good idea. If they've had insufficient training, they should not be doing this work unsupervised until they've been properly trained and so on. All right. There are a lot of people working in certain places saying they're bookkeepers, but they're really not bookkeepers, and things are really completely a mess in some of those places. And until management gets somebody in to fix things, it'll continue to be a mess. Sometimes though, persons hire persons who are not properly trained because they can pay them less money and they think they're getting away with something, when in essence, you're not really getting away. You're just getting closer and closer to some kind of disaster, sooner or later. Okay? And then finally, bookkeepers and accountants record transactions. Bookkeepers record the transactions, accountants analyze and report them. That only means that bookkeepers, by definition, will take the transaction, record it in the general ledger, and basically the bookkeeper's job would stop there. That's all they do typically. Can they do more? Sure, some bookkeepers are more experienced, they can do more, but typically that's what the bookkeeper does. The accountant then takes that information that the bookkeeper puts into the general ledger and then analyzes and set up the reports, look at those numbers to make sure that what's in miscellaneous expense, for example, is correct, and the items in there are acceptable, and so on, and what's sitting in all the other general ledger accounts makes sense and in terms of the analysis. Okay? The accountant also looks at the financing requirements of the company, whether or not the budget is adequate, and all this kind of stuff, taxation issues with inland revenue, IRS, whatever the case might be. All these things bookkeepers tend not to venture into, but the accountant's job is to go into that area. In some organizations, of course, bookkeepers and accountants are the same, and so they record the transactions and they analyze and do all this other stuff. So that is just to give you an overview of what the accounting process is in principle, just so you'd have an idea. You'll see a little bit more as we go, how this thing ties in. Yes.
I gotta ask this question, but
I wish you would.
whenever people say that I'm a lawyer, they used to say all lawyers are liars. Now, I said a cliche saying that all accountants are cheap. Is that so?
That is so. Whether or not it's true in both cases, in some cases it's true, in both cases, in some cases not. Depends on the lawyer, depends on the accountant. But yes, that is typically the cliche.
Yeah,
That,
I've heard that. I've heard that accounts are that way because they always trying to balance it.
Yeah, and not only trying to balance it, which is a critical aspect of the accounting process, but also trying to make sure that whatever expenditures that is going out of the company and whatever money is coming in are adequately and properly accounted for. And so they always question about raising questions like, do we really need to spend it for that? That's why they refer to as cheap. Do we really need that extra 10 computers? Do we need that extra piece of equipment for $3 million? And any accountant that is worth his or her salt will always be asking those kinds of questions in the interest, presumably, of the company. And so, yeah, it's because of stuff like that, the reluctance to just spend money helter-skelter, depending on what type of accountant you are. We've gotten the reputation of being quote unquote cheap.
Sorry, must see an accountant then.
Corey is a cheap guy.
I mean,
It's the
Mr.
treasurer.
Treasurers tend to be, like accountants. They tend, depending on who the treasurer is, they tend to be that way as well. Do we really need to spend money for that? Do we really need to spend money for that? We don't have money for that. We didn't budget for that. Do we really need to spend? And yeah, depending on who that treasurer is, you're gonna get that. Absolutely.
Yeah, the little joke that I say I saw on Facebook on the police accountant student went to a restaurant and saw gratuity on the bill, checking everything and say, I didn't know the gratuity.
Yeah, absolutely. Yeah, that's an accounting joke. Yeah, absolutely. And that's the essence of nitpicking, indeed. And so that's where kind of the reputation came from, because remember, accountants in the old days were referred to as bean counters, because they're always counting money, checking it, checking what's being spent, what's coming in, and trying not to quote unquote waste money, depending on the accountant that you are. Which is why if you're an accountant that works for any type of firm that likes to spend money, and you're an accountant that tends to hold on trying to waste money, you're going to always be at odds with your senior management. Okay, for sure. It's kind of like the Republicans and the Democrats. Democrats like to spend money, Republicans like to spend it too, but not to the same tune. And Democrats like to raise taxes, Republicans like to reduce taxes. And so they're always at odds with these issues. And so depending on what side of the fence the accountant is on, it gets stuck with the situation they're in. Yeah. So yeah, accountants tend to be cheap. All lawyers liars? I hope not. But history has found that too many of them tend to appear to be. Now I sound like a lawyer, tend to appear to be. Is that a yes or no? Well, we don't know, because you never really get a yes or no from lawyers, they say. You just get some fragment of a response that you need to consider further, given the situation concerning the matter surrounding the legal circumstance. See, like you really they keep tying you up. By the time they're done, you're like, what did he say? What did Arderio say? Nobody knows.
Principle behind everything.
Yeah, except for Arderio and other lawyers. Absolutely. All right. Okay. So now you know what we're going to talk about. And now you know, in essence, what accounting is. So let's look at a couple of accounting principles that are important to know, just for information. In case you hear it again, in case it comes up in conversation, you know why it comes up in the accounting world. Because these principles, these are not exhausting. There are other principles. I pulled out some of the key ones because you're not accountants and you don't need to be inundated with all of the mumbo jumbo. But there are a couple that you need to know just for information. Now, let me just say, first of all, that the principles that govern accountants' work is called Generally Accepted Accounting Principles, GAAP. Anybody ever heard about GAAP? The word GAAP? Not to fear, you're hearing it now. If you ever hear gap again, it doesn't mean like a gap in the road, GAP. It means generally accepted accounting principles. And these are the principles that are generally accepted accounting principles around the world for those persons who are properly practicing accounting. Now, nobody knows what accounting methods are used in China because you can't get a straight answer from the Chinese about anything, unfortunately. We don't know what is the truth about what they say, and we don't know what is a lie. They've always been a very introverted, closed-in society, and they only expose what they want you to know. My understanding is that persons in China, of course, you know, they don't have the right to speak freely, unfortunately, like we do, and the Americans and Canadians and Brits. They can only say what they feel the Chinese government wants them to say. Any journalist or person who speaks outside of that circle will be locked up, and some disappear and nobody ever finds them again, according to reports over the many, many decades. So they tend, like, they're like the Russians. They tend to have this little clandestine thing going on. They trying to get information from everybody, but they don't give any information. For example, has anybody heard what the crime statistics are in China lately? Anybody?
Well, according to them, there's no crime in China.
Of course, there you go. We all know that that is not so. We know what the crime statistics are in the US. Every morning you turn on the TV, somebody gets shot in Dade County, Broward, Florida, New York, Hawaii, somebody shoot 5 people, whatever, because they're always yapping. The media in China does not have that liberty. We don't really know. We don't know. China's already said that they have given 1 billion people the shot. Is that true? Not likely.
That's a lot of people.
Unless of course I'm getting 1 billion people mixed up with 1 million. But they say they've given the jab to 1 billion Chinese. Imagine that. As if the whole world is a complete fool on a plate. But the point I'm making is these generally accepted accounting principles, you will see them best practiced in countries like the United States, Canada, the Caribbean, the UK, and Europe. Once you get to the eastern part of the world, GAAP, GAAP turns into GAP. Because once you hit the eastern side of the world, nobody's sure what the hell they're doing. And the eastern side of the world, including Africa, except for New Zealand and Australia and those kinds of countries over there, nobody ever really knew what they were doing, especially from an accounting perspective. So this generally accepted accounting principles thing, God knows what principles they're using in those countries, if any. And of course, maybe Israel and maybe Saudi Arabia, a couple of them, maybe. But the Chinas of the Eastern world, the Africas of the Eastern world, maybe some African countries now, because a lot of them have British and French stuff, so they may be. But those other ones, Russia, China, Middle Eastern countries, are they using GAAP? Nobody really knows. Okay? Which means that any financial information coming out of those places are suspect. Do they have financial statements audited? Nobody knows. Maybe. But you don't hear anything about anything in those places. Okay? So when you hear GAAP again in accounting, that's what you're talking about. Now, what is GAAP? GAAP is what we call a very common set of accounting principles and standards and procedures that companies must follow when they put together their financial statements. So when your auditors come in to do your audit, one of the first things they're looking to see is whether your financial controller, CFO, and accounting department are following GAAP in terms of the recording of your financial transactions every day. So when you buy something, the recording of that transaction must be GAAP based. When you make an investment, when you buy property, when you pay salaries, when you pay utilities, whatever you do, every last one of those transactions have to be recorded. If any of those transactions are not being recorded, then your organization is not operating in conformity with GAAP. Because one of the key principles of GAAP is that all transactions must be recorded. And they must be recorded according to GAAP principles and standards and procedures. and you will be introduced to a couple of them just for your information. Okay. All right. I hope I laid that gap thing down thick enough so that at least if you hear it again, it wouldn't go over your head. Wait a minute, where the hell did I have? No, that's what we did, Mr. Wilkinson. That has something to do with how accountants should be recording transactions in the union. Okay. So in the next board meeting, when you have your auditors come in, you can ask a question even if you don't understand it. Excuse me, Mr. Jones from the audit firm. Are we following gap principles of the union? You don't even have to know what the hell you're talking about. Just ask it and see what they say. They should say yes. And then if you really like, man, that went well, then you can become the devil's advocate and ask another question you know nothing about. So how are we doing that, Mr. Auditor? And his answer you may not understand fully either, but you kind of let them have an idea that you understand something, even to the minimum. And whatever they say, at least, oh, okay, fine. You might be pleasantly surprised. They might say some crap they never said before to the board. Just remember, the auditors know that the board does not understand most of this stuff. That's the other problem. Which is why sometimes you should have that quote unquote INED, you don't have to call them that, but somebody who knows something about it sitting in those meetings. So that, especially those kinds of meetings, so that if your auditors are saying stuff that's a little weird, you don't understand a damn thing about it, that person will understand something, perhaps.
But could that person not also be in collusion with the auditors?
Of course, anybody can be in collusion, of course.
Okay.
But when you pick that person, you're picking them on the strength of their reputation and their credentials and as much credible information as you can, of course. Okay. Auditors are sometimes in collusion with the senior management of the firms they audit. Imagine that. According to GAAP and auditing practices, that's an absolute no-no. Accountants can lose their license for doing that. Audit firms can be shut down for doing that, but some of them still do. So yeah, absolutely. Collusion hasn't gone anywhere. It's still out there. In some cases, it's more subtle than others until something explodes and then everybody's exposed. But yeah, of course. Okay? So when you're doing these things, it's just like when you're dating somebody, you're hoping that whatever they present to you is the real person, but you're not sure. And you won't know for sure until you do what? Marry that person. Then you will discover who the hell they really are. And so, yeah, if you bring in such a person, sure, there's a possibility, but you do everything in your nomination process to try to see if there's any connection potentially, and do your due diligence to the greatest possible extent, and then say, thank God and oh Lord, hopefully we did enough. Now we have somebody who can help to interpret and help us understand some of the stuff that we really don't understand at that level. Okay, so yeah. All right, good point, good question. All right, so now that we know what GAAP is, let's look at what we call the golden rules of accounting. And again, these are just tidbits to kind of whet your appetite a little bit. Of course, you're not going to have to remember the details to pass an examination, to go and tell your accountant, like, go to hell, I know what you're doing. Step aside. That's not why you're doing this stuff. This is just to enlighten you so that by the time you finish this session, you'll have a little better idea about some of these things. Okay? So what are the golden rules of accounting? There are 3 of them. The first one says, whenever we have an accounting golden rule that's sitting in there, the first rule is that we debit the receiver and credit the giver. Now, what does that mean? Well, it means nothing until we find out what it means.
I always thought that was backwards.
I know. I'm glad you
It's
said
same,
that.
it's same backwards always. That's what always threw me with that. I could never get that because it's same backwards.
Doggone it. Thank you, Melanie, for saying that, because sometimes folks been backward and about it, getting it backwards, and then don't say anything, and then you stay stuck, and then everybody else stays stuck. So thank you for saying that, because that is going to prompt me to say something of interest. Okay. So
on that too, I had the same issue as Melanie did, and when that the state law office management accounting course, the same debit the receiver and credit the debit, because I guess it all goes back on what definition this is of a debtor and a creditor.
well, to
That's
some
like-
extent,
It's probably confused because the definition, then you look at, okay, I have a credit card. To me personally, that means I have I have something that I can use that I can, but in actuality, I have to pay that back and with interest and all that. So it's fun. And then if I owe someone a debt, that means, you see?
Yeah.
uh-huh.
Yeah. And in accounting, credit is really what goes out. Debit what's coming in. In banking terms, credit is what's coming in. Debit is what's going out. So that's where the confusion, I think, often comes for people.
Well, again, like everything else, it depends on the circumstances. Debits and
Yeah.
credits mean different things depending on the circumstances. And you'll see what those circumstances are very shortly. All right. So this first rule says debit the receiver, credit the giver. Notice what follows. This principle is used in the case of personal accounts, or what we call debtor-creditor accounts. What does that mean? Well, usually in accounting, if somebody gives you something or you own something, it is referred to as an asset, correct? Ever heard that?
Yes.
Yeah. It's referred
Yes.
to as an asset, and meaning we own it. And whenever we own something personally, we say that that account is debited because we own it. Now, some people might say, well, in the bank, my account is credited and I own the money, right? Going back to what was said a few moments ago. When we go to the bank, we said credit, what do? We give them $300 to credit my account, don't we?
Yes.
Don't we?
Yes.
You mean putting it on the account?
Yeah, please credit my account with this $300.
Okay, I don't really say that, but okay, I get your point.
What do you say, Melanie?
Put this on my account,
I know, but the correct term is to credit your account.
credit my account, okay.
Okay, so the next time somebody's having a discussion about your account and they say we credited the funds, now you know exactly what the hell they're talking about. What they mean that is that they put it to your account and it's your money.
They still charge you for it though, Mr. Gonzalez.
Sorry?
These banks still charge you for it.
Oh, well, that's another problem. And we'll get to that problem later. But the point at this point is whenever you make a deposit into your bank account, we say that your account has been credited for the amount of money you deposit. Whenever you take money off your account, what do we say?
Debit.
Yeah, the account is debited for whatever amount you take off. Now, that's the banking side of things. So money going on your account is credited in the bank. Money coming off your account is debited in the bank. However, outside of the bank, in every single other business practice, whenever you receive cash, it is always debited.
Debited. That's what I was just indicating.
I know.
Yeah.
And whenever you pay out cash, it is always credited. Okay? So don't mix up the bank transaction with normal business practice.
Can you explain the normal business practice?
Again, for the normal business practice, whenever you receive cash, you have to debit your cash account.
I mean, why? Can you explain why it's called that?
Why it's called debit?
Yeah.
Because it's called debit. I know what you're saying, Melanie. You'll find out very shortly that there's a rule in accounting called the double entry system rule. And here's the rule of double
Yep.
entry.
Must balance it then.
Yeah, for every debit, there must
It has to
be
be
a
credit.
credit.
Mm.
Yep.
At the end of the day, every transaction in accounting must balance. If it doesn't balance, you made a mistake or you deliberately tried to mess with the records. Do you understand?
Yeah.
Okay. Now, why do we use debit? Because it's the same way why do we use idiosyncratic for people who do weird stuff? Because somebody came up with the word idiosyncratic. Why do we use debit? Because debit means in accounting that we are adding something or we're owning it. How's that? So whenever we own something in business, we say we debit it, we own it. Does that help?
Okay.
It's a rule. Don't try, it's like heaven and hell. Don't try to figure it out. You just accept it or not. If you accept it, then you can be an accountant. If you can't, don't be an accountant. How's that? Because you'll find that as you study and practice accounting, the debit makes more sense. Before you're done with these next few weeks, the debit will make more sense. So hang in there, Melanie. I get your point. Okay.
Okay.
For now, the rule is whenever we receive cash, we debit it. And whenever we pay out cash, we credit the cash account. Okay. You'll see a little bit more of that later when we get to individual general ledger accounts. So hang in there. Okay. So the first rule, the receiver debits, like in this case, cash. Okay. And the giver credit. So if you're giving out cash, you credit your account. That's rule number one. Then we have rule number two. Debit what comes in, credit what goes out. Similar to one, just a little more expression. And the principle here is that whenever we're dealing with these kinds of principles, we're dealing with what we call real accounts. What are real accounts in accounting? Assets, liabilities, equity. Does that make sense to you? Hell no, but that's okay. Some of it will make sense eventually, okay? So, for example, if you buy a vehicle for your business, that is an asset. So therefore it has to be what? Debited or credited?
Debited.
See how it wrote? That's how you start getting it. Just like that. It's like after you learn the alphabet, you start reading, oh, cat, C-A-T, cat, like that. And after a while, it starts growing on you, Melanie, even though it doesn't make sense like at the beginning, like what the hell is a debit?
Mm-hmm.
It'll grow on you. Watch and see. So in the case when a company buys an asset, it debits the asset account. What happens when a company takes on a loan, a liability? What do you think that loan is? A debit or credit?
Credit.
A loan is always a credit because that is money that you owe. Okay, that's the rule. It doesn't change. Okay, the same thing with equity. Equity is always a credit, and you'll see that later on in our discussion of financial statements. And you'll see that when we discuss the accounting equation. And then eventually, all of this crappy stuff at the beginning in the golden rules will start to make a little more sense. Okay. So for now, just accept the rule as it is. You know, like when you're in preschool, 1 + 1 is 2, you don't know why, you just accept it. 1 + 1 is 2, that's it. Same thing. So you just accept the rules and then you'll see later on how they apply. Okay. Rule number 3, debit all expenses. Is there any ambiguity or doubt in there, like debit all expenses? Is there any room for doubt there?
No, sir.
No. So if you have an electricity expense, what do you do?
Debited.
If you have salaries expense,
Debited.
Debited.
chicken sauce expense,
Debit.
hot dog expense,
This is an expensive debit.
any, doesn't matter what the name is. Once it's an expense, it's always debited. If your company suffers a loss of any kind, what do you do?
Debit.
See that? I lost my fingers. What do you do for the company? Debit. Any loss is a debit. So you see, golden rule number 3 is very simple as long as you apply it. If you try to outthink it, you're going to get stuck. Don't outthink it, just apply it. And then what do we credit?
All the incomes and gains.
All income. So on Mary's piggy house income, do we credit that?
Credit.
As long as it's income, doesn't matter what kind of income it is, it's always credited. What else is always credited?
Gains.
Any gains you make. For example, if you buy a car for 5,000 and you sell it for 7, is that a gain or a loss?
2,000 gain.
2,000 gain, debit or credit?
Credit.
See what I'm saying? So all of a sudden, you guys who are not bookkeepers, now suddenly have a little more insight in how this crap works just by looking at 3 golden rules of accounting. And I can assure you, by the time this stuff is over, even Melanie will be saying, oh, that's what that crappy debit credit stuff is. And she won't be saying, I put it on my account. When she goes to the bank tomorrow, what do you think Melanie's going to say, Mel?
Credit my account. please.
Absolutely. Please credit my account. They say, mother's sick.
Oh,
How come she's saying credit not?
who she thinks she is? She's a
Yeah.
candidate.
Yeah, she always used to say, put it on my account. Now she said, credit my account. And
Okay.
furthermore, I don't want anybody in this bank debiting my account without my permission.
And then I gain the next week to withdraw. Please debit my account.
Absolutely.
Account of $500.
Yes. Please debit my account for $500 and give it to me. That's it. That's the beauty of this crap. So, not crap, you know what I mean? So, even in your own personal life, so it'll be helpful to you. The language in your board meeting with your auditors, all of a sudden it's going to be helpful to you in some form or fashion. The language, okay, and that's really the point.
Mr. Wilkinson.
Okay. Yes.
Wait a moment, sir. Like I said earlier, I take the big step. Okay, the bank gives me a credit card and a debit card. The credit card, they give me a ready charge with their money. Debit is my money, hook up to the bank. So I don't know, that probably is confusion with just the 2 names of the card. I mean,
Yeah.
you was food, but then the debit card, I don't have to pay anything back. But the credit, the bank money, I got to pay with interest.
But you know, I mean, if I could chime in here, from a former banking standpoint, it's simple and it's the same as just you were saying debit and credit just now. You know, the debit card, it's you taking money off of your account, so you're debiting your account. Credit in this instance with a credit card is they're giving you money to use. So technically, if you look at it, it's almost as if like money's being put in your hand or put to you, as you would be crediting your account.
Yeah.
It's just that the reverse of it comes in when you start doing transactions now, because now it becomes a quote unquote credit owing to you. But as long as the card is in your possession and the money is available to you, the simple banking principles will still remain until you start spending. Then it flips over.
Yeah, he's pretty warm. The debit card is just the electronic version of going into the bank and saying, debit my account for $200 and give me the cash. That's the electronic version of the debit card. The credit card, nothing happens with a credit card until you use it. The minute you use a credit card, then you take on a loan.
Those fines and those.
Yeah, the minute you use a credit card, you take on a loan. So let's say you put $300 in your credit card. Now you owe the credit card company $300, and you owe that plus interest until you pay it off in full, just like any other loan. Okay. Now, if you don't use the credit card, the only expense you will incur is the cost of having the credit card, which will be an expense to you. Once you use the credit card, then it becomes a loan that you have to pay off in full at some point.
That's my thing about it now. I have a credit card with $10,000, and then if I don't use that for any transaction, I still paying these fees.
No, if you don't use it, then you incur no loan. The only thing you will incur is
Just a service fee, the annual, probably the annual
having it in
service
your
fee.
possession.
Yeah.
Service fee
Yeah,
or an annual fee.
that's what I'm saying. Pay annual fee. Nonetheless, you're paying something. My
Of
debit
course,
card,
of course.
I take the money off and so long, see ya. If I choose.
Now, I know what you're saying. Now, what you're saying is, since if I have a credit card and I don't use it and I still have to pay, I may as well just use my debit card. You're right. If you flicking out money in it all the time, the difference between a debit card and a credit card is if you
You
have
spending your money.
if you have $3 in your account and you need 500, you're stuck. But if you have a credit card, you're not stuck. You can get a loan for what? $500 and then pay it back.
That's maybe a question thing. I before the debit card goes.
No, that's okay.
And it's
No,
done. I said, I gotta repay it.
remember, if you're the guy who always have enough money in your account to cover all your stuff, then you don't need a credit card. Just let your debit card roll. But God forbid you run out of money for some reason and you don't have a credit card, then you're gonna be stuck. But if you don't need a credit card, don't get one. Because if you're the kind of person that always has enough cash flow to cover whatever you need, then you don't have that concern. But not all of us are like that. We run out of cash flow, some of us. And so we need that credit card like an overdraft facility back up. So if we run out of money during the month and we get a flat tire or the car stop working, we don't have to borrow from anyone. We could use our credit card. And that's kind of why some people have credit cards. Others have credit cards just to waste money by getting loans they don't need, by buying stuff they can't afford and don't need, and then they have to end up paying them back. Going to the mall.
As an account specialist.
Sorry?
As an accounting specialist, which one would you prefer?
It depends on the person's financial position and cash flow. If you are the kind of person who have enough money from generally to cover your expenses, then you don't need a credit card. But if you're that person who has 3 children, 5 children, you run out of money during the month potentially, you may want to have a credit card as backup. So that if you run out of money, you could still function.
Yes, I always was taught that having a credit card is for emergency purposes.
Well,
You don't
that's
get
what
it,
I'm
it's
saying.
worth it.
See, people who have lots of money, they go shopping with a credit card and then take lots of money and just pay it off. But regular working people don't have that luxury. When we go shopping, just wasting money with a credit card, we have to we pay the minimum balance and we have that balance until Jesus comes back, which is not the ideal situation. So it's all about the proper management of your finances. Okay. If you have money that to burn, you take your credit card to the limit and then take the money and pay it off. But if you don't have money to burn, then your credit charge should just be for what? Just as he said, emergencies. Okay. Now remember, different people have different emergencies. So some people might say, oh, I don't really need to use my credit card much. I just have this in case I run short. That's fine. Maybe you don't have 5 children. And if you don't have 5 children, you have no idea what the hell's going on in real life. Because it's only when you have a couple of kids you understand what real emergencies are. Some are predictable, some are not. And every now and then, some are unbelievably out of left field. Okay? So yes, everybody has to look at their own individual situation, their family life, their responsibilities. If you're single, married, children, none, and then you make your decision as to, first of all, whether you need both cards, credit and debit, and how to use them both given your situation. Most of us would like to just have it for emergencies if you have to. Some of us have the luxury of using it just to shuck and jive because we have a lot of money coming in from somewhere to pay it off in full and so on. And others of us should never even have a credit card because we're going to abuse it and suffer the consequences for one reason or another. So it's a purely individual thing.
I think that's the major problem with other people who have the American Express and those who American Express where you credit and You just take a lump sum, pay all back one time. You ever do minimum payment.
Of course.
The whole card. But I think that's where a lot of people run into issues right now with credit cards because it almost like it's in your and you put your handbag, your wallet, your bill and it's tempting you. Because you know it's there and you have $5,000 or $2,000.
Well, of course.
And you see something and you say,
Of
well, you know you
course.
don't need it. But the fact that you have that like a charger, that's where the problem comes.
So it's all about the person. Just like some people are greedy, some not greedy, some sort of greedy, and some super greedy, and some exceedingly greedy. So we have all kinds of different people. Yeah. Some people cannot overcome the temptation. Other people can see it and never touch their credit card. It's easy for them to overcome the temptation. It's all about an individual thing. And we have to govern ourselves according to our weaknesses and our strengths and who we are. And if we don't do that, we will suffer the consequences, which many people do, by the way, every month, sometimes for the rest of their lives for some reason. They don't seem to get it.
Just
All
when
right?
you use that word, I just want to say, even if you proper governance and management of your wallet.
Yes, absolutely. Okay, absolutely. Absolutely. For me, back in the day when I had a credit card, it was because I had kids. When you have children, you always have crappy things to do. When my kids were growing up, high school, university, you better have a credit card. If you don't have all kind of money rolling out like not Simonets, the Simonets and the Wilsons and the Tingham, the Pinders and all that. If you don't have that kind of money, don't mess with that crap. You need a credit card, but you need it for when you need it, not for stuff other people do. Okay, absolutely. So again, it is an individual thing. You have to exercise your individual prudence based on your financial circumstances and your responsibilities around you. Are you single? Are you married? Do you have children? And blah, blah, blah. Do you have a mortgage? Whatever the case might be. All of those things will determine whether or not you have the two cards and how you use them. Okay? And like any cash situation and borrowing situation, you have to exercise the greatest possible wisdom, or else you will suffer the consequences. Okay? Excellent points. Like that, the point is, this stuff is not only good for the board, it's good for individual day-to-day stuff as well. Okay. All right. So Mel, way to go tomorrow. Tell them credit your account and don't debit it until you tell them. Listen, what the hell this chick swallowed? Counting stuff. All right. The other thing I want to mention, just for the record, because somebody alluded to it earlier, when you make a deposit in the bank will not debit cash because it's not the bank's money. The bank credits cash because it's a liability to the bank. When you make a deposit in the bank, it's a debit for you, but a credit for the bank. And it's a credit for the bank because the bank is holding it for you. And so they owe you the money, such that anytime you come into your money, it's a liability. They owe it to you. That's why it's credited in the bank. In your personal accounting records, it will not be credited. It will be debited. Which rule is that? Your personal accounts. Which rule is that? Debit cash. All right. Number one. Absolutely. Okay. So now you know why the bank credits cash. And now in your personal records, you will not credit cash. You will debit cash. How about that? All right. So welcome to the world of accounting. All right. Now for some fundamental accounting principles, just to wheel you in on some of the things that accountants are thinking about, bookkeepers, as we do this work, as the auditors do the work, as the people in your accounting department do their work, to make sure that the finances are properly done and that part of the business is properly governed. Okay? A lot of problems in organizations occur in accounting and finance, unfortunately. Those are not the only areas, but a great deal of problems all come all the way from the board level, sometimes all the way down into the accounting department, messing with the numbers, playing games, running some unethical, and sometimes, in some cases, even illegal activity. All right. Principle number one, the monetary concept. All that means is simply this. Accountants record all transactions in dollars and cents. That's all that means. That all transactions are measured and expressed in monetary terms. Monetary means dollars and cents. No sweat, don't lose any sleep. You could read the definition, but just know it means transactions are recorded in dollars and cents. Not chickens and goats and trees and rabbits, dollars and cents. Principle number 2, the going concern. The credit union is a going concern. Any organization that is believed to will be in business beyond 12 months is considered a going concern. All that means is if the belief is that you will be in business after 12 months, which is the normal accounting period, then your organization is referred to as a going concern in accounting. If for some reason the auditors believe that the organization will not last 12 months for whatever reason, then they will say that they cannot say that it's a going concern any longer, because given the financial position in 6 months or 8 months or 10 months, this particular organization might be out of business. Okay. Of course, in your case, that does not apply. You guys continue to be a going concern. Okay. Notice the definition that the functions that the going concern is the business that functions without the threat of liquidation. So that's you guys. For the foreseeable future, usually beyond 12 months. Okay, but generally without the threat of liquidation for the foreseeable future. Can you guys foresee any liquidation in the union? Like something that will cause you to close your doors and go home for good? Can you foresee it at the moment?
Not right now. Can't think of
Not
it.
right now, but it sure as hell something to think about for the record. Not that it lies in the case. All right. Principle number 3, the cost principle. What does that mean? In accounting, everything is recorded at historical cost. In other words, if you paid $50,000 for the property, that property is debited for $50,000. Doesn't matter what the market says it is. If the market value is $80,000, in accounting, we do not record $80,000. That's the market value. In accounting, we do not record the market value. We record the purchase price on the purchase invoice between the buyer and seller. Does everybody get that?
Yes, got it.
Okay. People are still asking me, why are you recording when I do client work? When I'm preparing financial statements. In fact, I'm doing one for a guy now. And he has property. And he wants to know, why am I recording the property at the invoice price, at the cost? Because the property based on the appraiser's appraisal is twice the amount. He wants me to record it at the appraiser's value. And I have to say,
But you can't do that.
well, you could do it.
I mean, yeah, you could do it, but then it's not a true account.
Yeah,
It's
it
not
is a true, no. It is a true account. Here's what I mean. If you're selling property let's say you paid $50,000 for the property 3 years ago, and you're selling it 3 years later, you're not going to sell it for $50,000.
Okay.
Right? You're going to have it appraised, and the appraiser is going to say $80,000. So you're going to come to me and say, Mr. Wilkinson, I'm selling it to you for $80,000. Why? Because that's the current market value. So it is okay to record it. The problem is it is not okay under generally accepted accounting principles. Everybody get that?
Okay, got it.
That's the point. Here's what accountants do. We record it at the cost of $50,000, and if you sell it for 80, the 30,000 becomes a G word. What is that word? We saw it earlier.
G? G? You said G?
The G word.
Again, yes,
How
again.
much?
Again of 30,000.
That's how accountants do it. Do you follow that?
Yeah, I got you now. Yes.
Okay. Right. And I often have to explain this to clients all the time because they don't really get it for a while. And they want to know, why am I recording certain things a certain way? And I tell them it's because GAAP requires it. And they say, well, the appraiser said something else. I said, I know. The appraiser could say anything, and that's fine. and if two people agree to buy and sell on that level, that's fine too. But for accounting purposes, this is what we do.
And that all in the of balancing the sheet, which the sheet.
Of course, and it's all about following the rules. It's like the 10 Commandments. GAAP is the 10 Commandments of accounting. Does everybody get that? Thou shalt not kill. See? Thou shalt not steal. Thou shalt not. Now we could come up with all kind of crap. I kill him because he tried to kill me first. I kill him because I get mad. I kill him because I see him with my gal. See, those are all variables. We could come up with that. But the rule is what?
General principle, thou shalt not kill.
Rule is thou shalt not kill. Whatever excuse you came up for doing it, we get that foolishness. But the rule is don't do it. That's how GAAP works. Okay?
Right.
All right. So the cost principle says whatever you paid for it, that's what we recorded at in the financial records. If the appraiser comes up with something different, fine, no problem. We can deal with that later as a gain or loss. Okay? That's how accounting works. Accounting conservatism, that's another important principle in accounting. It just simply means this. Whenever we are recording profits in accounting, we seek to make sure we don't overinflate them, profits or sales. Whenever we're recording profits and sales in accounting, we seek only to account for the profits that we can actually prove or sales. On the other hand, when it comes to expenses, we try to think of every possible expense that happened that year to include it in the income statement. Okay, that's what conservatism means. So on the sales side, we stick only with the actual sales that we can prove, and on the expenses side, we make sure we include every possible expense in that income statement. Okay? And possible losses, they too are estimated and included in the financial statement for that year. Do people agree with that rule? No, not everybody agrees with it, but accountants don't care. Doctors have their rules, lawyers have their something, engineers have their something, and accountants have their GAAP. Okay? And the reason why accountants have this GAAP is so that accounting information can be consistently done the same way every year, every time. Okay? When you go to an economist, 1 month he's telling you one thing, and the next month he's saying something else. When you go to an attorney, one minute they're telling you one thing, and the next minute they're telling you something else. Accounting doesn't work that way. Accounting is very consistent. Once we start doing a particular thing, we stick to that forever unless something happens to cause us to change it. And whenever that is changed, we have to give good reason for making the change. That's how accounting principles work. Okay? Just for the record. And notice we have a whole bunch of other accounting principles. Of course, you can Google any one of them and see what they all mean. But very quickly, for example, the economic entity assumption has to do with the fact that accounting is part of the buying and selling process, and transactions are recorded according to those transactions. Okay. The monetary unit, we already saw that. Information is recorded in dollars and cents. Time period assumption means basically that accounting period is usually 1 year. So whenever we hear about the accounting period, it's usually 1 year. Can you get accounting information before 1 year? Definitely. You can get accounting information daily, weekly, monthly, quarterly, semi-annually, anytime during the year. But the time period accounting principle says that accounting periods are designated 1 year over year. Okay? So your audited financial statements will always be for 1 year. The typical financial statements according to GAAP would always be for 1 year. Can it be for 3? Yes, but that will not be in conformity with GAAP. GAAP would consider that too long a period. Can it be 3 months? Yes, but then 3 months would be considered too short a period to make the proper accounting assessment. So GAAP has chosen 1 year as its time period assumption for accounting transactions and reporting. Okay. The cost principle we already discussed. Information is reported at the buying and selling price, not the market price. Okay. Full disclosure principle means that whenever your accounting people are putting information in your accounting records, they are required by GAAP to put everything in and not leave anything out. Don't hide anything. Don't duck and dodge. Don't put stuff in that's incorrect. Don't leave stuff out on purpose so the board and members and shareholders and others cannot find it. Don't put it in a language that people can't understand, and so on, hiding information. That's what full disclosure principle means. If we are doing our jobs properly as accountants, we must disclose fully in the financial statements and in the notes to the financial statements everything that has occurred, even if it's not favorable to the organization. Okay? There's no secret in many organizations when things, in transactions and things occur that is not favorable. They don't want the shareholders to see it. Board doesn't want members to see it. They're trying to hide it from the tax guy, whatever it is. They fail to give full disclosure. If any accountant does that, he is violating the full disclosure principle. And in practice, if any licensed accountant discovered doing that, their license can be revoked, depending on the consequences of that action. Because failing to disclose fully is a form of deceit. And to some extent may even be fraudulent, depending on what you're hiding. So these kinds of things, just for information, is good for board people to know from an accounting perspective, because you have accounting departments in your organization. And you have auditors who come in at least once a year to conduct audits and tell you stuff at the end of the audit. Okay. Going concern principle, we already talked about that. You can see yourself in business for a foreseeable future. The matching principle is simply this. If you have sales and expenses occurring in 2021, they should all be recorded in 2021. 2021 sales and expenses should not be anywhere in 2020 hidden, or anywhere in 2022 that has not yet bloody arrived. And even when it comes, you still can't put 2021 in 2020, in 2022, or anywhere else. This principle says all the expenses and revenues that are generated in a particular year must be recorded in that year. So if you're in a board meeting and somebody said that $50,000 of expenses have been held to be put in the income statement for next year, that's the problem. Or that an adjustment was made for $50,000 and has to be shown in last year's statement. I'm not saying that something didn't go wrong last year, but as a board member, you need to find out why. Like, why are you doing that? Because according to the matching principle, all expenses for 2021 and revenue for 2021 should be in 2021. But again, remember I said, if people are acting unethically, they can find, as you can see already, a million ways to be unethical, and in some cases illegal, by simply not following through with GAAP requirements. For one reason or another. Okay? The revenue recognition principle says whatever revenues you make must be recorded at the time they are earned. Revenue must be recorded at the time they are earned. So those interest income revenues that you guys make from loans for 2021 must be recorded in 2021. If you made the revenue in January, they must be recorded in January when you generate the revenue. You should not put January's revenue, for example, in July's revenue. January's revenue should be in January, and everything for 2021 in revenue should be in 2021. None of 2021's revenue should be in 2022 for no reason, or 2020 for no reason, unless there's a major adjustment that has to take place because of an error. But other than that, revenues must be recognized in the period or year in which they are earned. So interest income revenue in the year in which it's earned. Interest expenses and other expenses in the year in which it's incurred. That's how accounting works. Okay. Nothing else will be sufficient. GAAP requires that it's done that way. Doesn't matter if you agree or not. If you're practicing accounting, you must follow these principles. Okay. All right. Any questions so far on that mouthful of principles? So now you can see these financial principles are similar to the other corporate governance principles that we were looking at for the last couple of weeks. So even though the context might be financial, the principle remains the same. And these things we need to govern ourselves accordingly. It's just that it's now from a what? Financial perspective as opposed to a conceptual, ethical perspective. Trust me, a lot of accountants and bookkeepers and managers and CEOs and board members around the world, they are constantly trying to manipulate accounting information for their own personal or company, whatever the reason is. They always have a reason. We want bigger bonuses. We cannot afford to have the shareholders and members know that we use the company money to go on a trip to play golf last year in Waikiki, whatever it is. We cannot let them know that $80,000 of that professional fees went to my cousin who has a legal firm somewhere, and so on. So again, these principles are just as important and just as strong as all the other principles you've learned so far. And all this information is really just designed, and we're doing this so that you guys as board members, and now even in your own personal life, as you can see, will know hopefully how to respond to certain things, even without having all of the intricate knowledge of it. Okay, just being aware of it is oftentimes a great deal important and very helpful in getting the job done, as you've seen and as you will see. Okay, for sure. All right. So having looked at the golden rules, the gap principle, and all the laundry list of accounting principles by which we are governed in this profession, we can now inhale for a moment and then take a moment to look at what we call the accounting cycle. Now, the only thing that's important for you guys as board members to know is that in accounting, the process is what we call a circular one. And when you get to the end of the circle, it starts all over again. That's the consistency principle in accounting. Once we start doing things a certain way, accountants do it that way forever until something happens to cause us to change it. And then even then, you have to give a good reason for changing it. You don't just change it because you had a dream or somebody told you to do it. It doesn't work that way in accounting, which is why a lot of accountants run amok with a lot of CEOs and board members who want them to do things they know as accountants they should not and cannot do, and they're being pressured to do them. And sometimes that pressure gets as far as, you want a bonus this year, Mr. Jones? You want to continue working here with that fabulous salary we pay you? And if you do, then I suggest you do what we want, or else we, the board, the management, the whatever it is, will find somebody who will, Mr. Jones. You're like, oh my God, I just want to do the job properly. Maybe, and that's the correct way to go. But it doesn't mean that even at the board level, you will not be confronted with things that will test your conscience, your ethics, your interest in good governance. All right. So now we have the accounting cycle. And the accounting cycle is really just the whole process of bookkeeping and accounting that goes from analyzing a transaction all the way around to the preparation of financial statements, and then we close the financial year at the end of 1 year, and then we start again in the new year. The cycle begins again, all the way to the end of the year. We close the books at the end of the year, begin a new cycle in the new year. And that goes on forever and ever. Amen. That's what we call the accounting cycle. Now, how does this cycle work? Well, remember I told you in accounting, we don't record anything until after it happens. So, whenever a transaction occurs in your union, somebody needs to give your accounting department what we call a source document. Some kind of paperwork, not lip service, not promises, not the wrong paperwork, the correct paperwork for every single transaction. If you got $10 out of petty cash to do something, buy some printing paper from John Bull, no problem. When you go to John Bull, please bring what back? Anybody?
Bring the receipt.
Simple. Now, somebody comes back and say, I lost it. What happens then?
And you gotta, I guess, make a receipt. I mean,
Suppose they didn't really lost it,
well, that's true.
but they may have really lost it. So now you have to make a what? Judgment call, correct? But the real point is, we don't worry about whether it's lost or not. If it's lost, we have to make a judgment call somewhere. What the key thing is, there should always be a document to prove to the accountant and the accounting department that the transaction actually happened. Okay, folks? And no matter what the discussion is, from $10 to 10 gazillion dollars, if there's no proper document to prove the transaction occurs, then that should be regarded as a suspicious transaction right off the top. Even if later they discover that it's not, until it is cleared up and fixed and a proper document is produced, the accountant cannot properly analyze that transaction without the proper documents. And that's where the cycle begins. So if you don't produce the proper documents, the source documents, then the rest of that cycle that you're looking at is null and void, unless you decide to go ahead with the transaction without the document, because you're under pressure from somewhere, some board member, chairman, the CEO, to ting them. But as the accountant, no matter what the pressure is, you cannot start the rest of that cycle without the proper source document in your hand. Doesn't matter what they tell you. Boy, we firing you. Okay. You can fire me but I'm required to get the document before I can begin the first step in this cycle, which is to analyze the transaction to see what happened. Okay. So let us assume everybody's doing it right. They bring you a source document for the transaction. You analyze it and say, okay, this is a transaction for purchasing property. I have the bill of sale for the property. All the relevant signatures and stamps are on them. This is a legitimate document. Once you analyze that part of the transaction, now you can go ahead and record it in your journal. Okay, step number 2, record it in the journal. I'll show you examples of this later when we get to that stuff. But for now, you analyze it, you have your document in hand, because when you finish all this stuff, you're going to file that document. And it is a very powerful weapon. That's why I told little Sam, don't you deliver anything without a document proving that that transaction, that he gave the instruction in his case. Okay? No money changed hands, but the fact that he gives authorization in writing through that email would be equivalent to money changing hands in terms of the source document. Because remember, in a court of law, if you cannot produce a document, nobody wants to hear you. If you say something and you can't prove it, nobody's interested, even though they might believe you. Without proof, dog eat your lunch. The only person they seem to lock up without proof is Bill Cosby. He's out now, isn't he? Isn't he?
Yes, he is.
Yes, he is. But nobody has said anything about the fact that they locked him up improperly. How come? Let's go back to corporate governance now. They had a big hullabaloo when it was time to put him on trial. Paraded the old guy who did so much for America, black, white, blue, and green. Claire said he did that and this and that without evidence to prove he did it. No DNA, no spit, no nothing. Locked him up. Then they discovered 3 years later that they were wrong, but yet nobody came back after he was released to say anything. Is that good governance, Clark? My.
It's not good governance.
See, no, it's not. Okay? And
Because if you look at what happened with Martha Stewart, she actually was wrong, served time, and still came back out and richer than she was, based on the color, color of her skin.
Of course. Not only is not good governance, it was racist
Man,
oriented.
prejudice.
You know, yeah, these are all realities. And even to the colorblind person, if you rip the dude up when you thought he was guilty and you found out he was innocent, then you have to come back and what? Flick apologize, right? But nobody apologized. Even Black America didn't support him and come back and say they wrecked this guy. Nobody said anything. And that goes back to that thing somebody was saying earlier in the group, where in organizations, somehow we learn to become complicit. We learn when to carry on, when we learn when to shut up, even though we know we shouldn't shut up because it's wrong. We just learn to shut up. And all those accolades that he did and served so many Black, white, and green Americans that they took, they didn't put them back. They just acted as if it never happened. Point, governance is everywhere, even in such matters. While we talk about it in the central bank and trust companies, credit unions, charities, accounting practices, it goes well beyond all of them, even unto these kinds of matters. My. All right, so we analyze the transaction. Once we get a source document, we record the transaction in our journal. Step number 3, what do we do? What's step number 3? Anyone? Step number 1, we analyze. Step number 2, we record.
Step number 3, post the ledger.
Yeah, we post it to the ledger. And again, you will see all of these eventually. See how they
Thing
look?
right there.
Sorry?
Sorry, I was talking to somebody.
Okay. All right. Step number 3, post to the ledger. What about step number 4? What is that? What is that?
Unadjusted trial balance.
Yeah, an unadjusted trial balance. We'll see what a trial balance is later, but really a trial balance is just listing all the debits, listing all the credits. And if you're doing your bookkeeping properly, they should equal. That's how auditors find out if your accounting records are in order. At least that's one of the main ways. When they come in, they say, let me see your trial balance. They look at all the debits in the column, all the credits in the column, and they should equal. If they don't equal at the bottom, then the auditors know something is wrong. You as board members, you may not know a bloody thing about anything, but you could say every other board meeting, can we see the trial balance from the accounts department? They say, what the hell, the board people? What they know about any trial balance? Well, you know now. When they bring you the copy, you look to the bottom. Do they balance? If they balance, you hope it means that everything is fine. Doesn't necessarily mean that, because we can make anything balance, but we hope that the accounts department is operating with the kind of integrity that when you look at your trial balance and it is balanced, that it means that all is well. If you as a board member look at the trial balance that they don't balance, you don't have to know nothing about accounting to ask the question of your out of balance. And the difference is $300,000 or 50,000 or 10,000 or 3,000. The point is, why doesn't a trial balance? So tomorrow, or when you have your next board meeting, you can say right away, just for the hell of it, be the devil's advocate like Odirio. Excuse me, can we see the trial balance? The board would like to see the trial balance. And you're not interested in the details necessarily. You just want to look at the bottom to see if they what? Anyone? You're looking to see if it's what?
If it balanced,
Yeah, if the total debits at the bottom equal the total credits at the bottom.
that's the balancing part of it, eh?
Yes, it's called the trial balance. All right. So if you feel froggy soon, like tomorrow or next week or whatever, you can go to your accounts department as the director or from next director's meeting and say, can you please send us a copy of the trial balance? And the only reason why you want to see it because you want to look to the bottom to see if they balance. You might be surprised one of these times when you look at the bottom, it may not balance. And if it doesn't balance, you know you have a problem, Houston. So you will ask the next logical question as a director or as a board. Why does it not balance? We need to know why it's out of balance, and we need you to tell us exactly why it didn't balance. That would be quite interesting for any trial balance that doesn't balance. It may always balance, but you never know. That's why you have auditors come in every year, not because you think somebody's doing something wrong on purpose, but just in case. And it's not always deliberate. Sometimes people make mistakes. And it's not because they're up to no good. They just made mistakes because they weren't careful. They are not properly trained. Nobody checked their work. It could be any number of things. That's the side where people make legitimate mistakes. On the other hand, people do some things that are not mistakes. They do some things that are very deliberate. And depending on how long they've been in the organization, how experienced they are, they can do stuff and you'll never find it. And if your control measures are weak, they will get resources out of the company and you'll never know, or the union, or wherever it is. Spooky, but true. All right, so we have the trial balance, which is step number 1, 2, 3, 4 in the cycle. Then after the trial balance, we have what we call the adjusting entries. And these are just entries to correct anything that is wrong or incorrect in the financial statements. And then once the adjusting entries are done, then we come up with what we call an adjusted or corrected trial balance. And the reason why we need the trial balance to be totally correct, as usual, is so that when we prepare the financial statements, and the financial statements that go to the members, the bank, the shareholders, the government, and whomever gets them will be getting financial statements that are relatively true and correct. God forbid. Okay. And then at the end of the financial year, when the statements are done, then we have what we call closing entries. And what are closing entries? Closing entries simply mean this. At the end of the financial year, all the revenue accounts are brought to zero. All the expense accounts are brought to zero. And so at the beginning of the new year, the income or revenue and expense accounts start from scratch again. That's all closing entries mean. The balance sheet accounts are not closed. They remain open forever until the company closes. But income statements, every year, we bring those transactions for the year to zero. We start afresh for the new financial year. Question, anybody on the cycle?
Nothing.
No,
Okay, so there you have it. A little introduction to what we call the accounting cycle, just to kind of get you attuned to how accountants do their work every day. Again, you're not here to be accountants, you're just hearing some of the language of the profession. And so that when you sit in your board meetings and you listen to your auditors and you listen to your financial controller, CFO, whatever, some of these things will not be totally unfamiliar to you if they come up, especially things like financial statements and source documents to prove the transaction actually occurred and that kind of stuff. You especially would be great if you can somehow keep some of those little things in the back of your mind so that if anything comes up, you can question them. Okay. All right. So I think I'm going to say a few things about the accounting equation, and then I'm going to let you guys go and put your feet up because I know it's been a long day again, and I keep going and going and going. All right. So the final thing we're going to talk about this evening is the accounting equation. And the accounting equation is what we consider to be a very simple equation in accounting, but it is a very important equation. Okay? And what is the rule for the accounting equation? As you can see, it says simply that all the assets in the credit union are always equal to, you see that equal sign? Your liabilities or what you owe, plus your equity, or what you call maybe accumulations in the credit union. In other words, this equation must always be in balance on your balance sheet, or else something is wrong. For example, if I tell you that your liabilities are $10,000 and your equity or accumulation in the union is $20,000, what would be your total assets according to this equation?
10,000 minus.
Liabilities are 10,000.
Mhm.
Equity is 20,000. What would be your assets?
My 10,000.
Oh.
Liabilities plus share equity,
Plus.
which would be plus, yes, 30,000.
Absolutely. According to this formula, it'll be what? $30,000 in assets. Okay. Give you another example. Let's say your assets are 100,000 and your equity is 50,000. What would be your liabilities?
50,000.
Way to go, doggone it. You guys catch on quickly, okay? And that's how the accounting equation works. So anytime you pick up, for example, even a balance sheet, just like the trial balance to see if the balance is at the bottom, you can look at your balance sheet to see if it's balanced. So you look at your total assets, and you know based on this equation that your liabilities plus your equity must equal to those assets. If they don't equal, somebody made a huge mistake somewhere. Okay, for sure. And out of this equation in accounting, this accounting equation comes what we call the double entry system of accounting, which we said earlier is what? Anybody remembers the double entry system of accounting? For every debit, there must be a corresponding credit.
Credit.
Yeah, credit. Some people believe that credit and creditor are the same. They're not. Okay? For accounting purposes, for every debit, there must be a credit. For every credit, there must be a debit. That is called the double entry system of accounting.
The credit goes out and the debit comes in, right?
Absolutely.
So
Sometimes
credit
students
be
say,
like expenses. Would credit be like expenses and liabilities?
not really. Credit would be things like when you pay out money.
Okay.
Yeah, if you incur a liability, that would be a credit as well. Remember the golden rules? So if you incur a liability, yes, that would be a credit.
Okay.
If you incur an expense, what would that be?
A credit, eh?
Expense. Golden
Um,
rule. Anyone? Help, let's bump him along. If, according to the golden rule, if you incur an expense, what is that?
I thought it was a credit.
Expenses are always
Debit.
yes,
Debit,
debits.
debit.
Oh, they're debits. Okay.
Expenses and loss are debits. Gains and credit.
Gains and income are always
Incomes are credit.
absolutely,
Credit.
absolutely. Okay.
Okay.
Yeah. So basically, once you get that basic rule down pat, it's hard to go wrong. You just follow it because it never ever changes. Okay. That's the beauty of this profession. Once you learn the rules, like any other rules, like driving on the left-hand side of the road, once you learn the rules, it becomes very easy. The only time it becomes messy, it's like anything else. If you drive on the wrong side of the road, then it becomes messy. You're gonna run into someone, get a ticket, and all this kind of stuff. Okay, accounting is like that. Once you learn the rules, they apply every single time, and the only time you run into trouble if you violate the rules. Okay, so the accounting equation then is assets equals liabilities plus equity, which is what you should be able to see on your balance sheet, and we'll see that next time, how that looks on the balance sheet. And of course, the double entry system of accounting says for every debit that you make, you must make a credit for the same amount. For every credit that you make, you must make a debit for the same amount. If you do not adhere to that rule, your accounting records will never be complete. They will forever have errors in them and they will never balance because of you not following the debit credit rule. All right. So if you buy a car for $50,000, you have to debit the asset car for $50,000 and you have to credit the asset cash for $50,000. So it balances. You debit the car you receive, credit the cash you pay out for the car. But there must be a debit and credit for every single transaction, whether it's 1 cent.
Let me chime in.
Yes.
If you buy a car on credit, it won't be cash. Would it be accounts payable or
accounts receivable, which is an asset, and therefore it'll be what?
Yes, it'll be a debit.
Because remember the rule: assets are always
Credit debit.
Yes. See, so even though you buy it on credit, the accounts receivable is an asset, and since it's an asset, it will still be debited. Absolutely. Welcome to the rules. The rules don't change.
I think the thing is, even though you buy it on credit, when you finish paying back your credit, it still is your asset.
Yeah, but it'll be offset with accounts payable and accounts receivable.
Yeah,
Right.
what happens is when you buy it on credit, you debit accounts receivable. Sorry, when you buy it on credit, you will still have the vehicle. If it's a car you bought, you will have the vehicle as a debit. I think I follow what you're saying. If you're buying a car on credit, you will have the car as an asset, and then you will have a loan on the other side for the car, which is a credit. If you sell on credit, then you will have accounts receivable as an asset.
Right.
Okay. because you expect to be repaid, and then you'll have credit sales on the other side. Okay, and we'll see a couple of examples of how that works. But you are basically getting the gist of it in principle in terms of how it works, and that's really where we want you to be. So that if you hear this stuff in the air at a board meeting, in a conversation, you have a basic idea of what the hell's going on. Okay, and that's really the key. All right, so I think we'll stop there for this evening. When we come back next time, we'll pick up from the accounting equation and get into some more of how this thing works and how the governance side of it applies. I think you have a pretty good idea that if you don't have a handle on these principles and these guidelines and these gap requirements, that your company can be easily exposed to poor governance, whether it's by mistake or on purpose. And so auditors and directors and others have to constantly be looking and trying to make sure that the financial side of things now are being done correctly. Otherwise, your governance position is going to be in question. Happens every time, all the time. Companies are getting fined millions of dollars all the time because of poor accounting practices. Okay. All right, so no other questions. We'll break there for the day, and I'll see you guys on Thursday, and we'll pick up some more of this good stuff. Have a great week, and I'll see you on Thursday.
Take care, everyone. Have a good night. Take
Okay.
care.
Good night, everybody.
Nice.
Good night, everybody.
Good night, Mel.
Good night.
Good night, Kevin. Take care. Corey, are you there? Corey. Corey's off. I just want to tell him he knows what he shouldn't do. Don't do anything. Wear his mask. Stay away from folk. And when he sees people, run.
Good to hear from him, though.
Sorry?
No, I said it's good to hear from him, though.
It certainly is. I was very worried about that situation because so many people have gone down in one form or another. So yeah, it was good to hear from him, period. All right, seriously. So you guys be careful out there. That job that you have doesn't make it any easier, God forbid, but give it your best shot, okay?